Today, I'll be talking about alimony tax rules. But first, let's address why these rules changed. Back in 2017, Congress passed the Tax Cuts and Jobs Act, which overhauled the U.S. tax system. One reason behind that change was that Congress wanted to generate more revenue. Yep, big surprise, right? Congress wants more revenue. It's not really surprising, though, because it was an easy target. One of the reasons for that is previously, when someone paid alimony, they could deduct it from their taxable income, but the recipient also had to report it as income. This system led to a net loss for the government because the payer typically deducted more than what the recipient reported, not to mention the different tax rates between the payer and the recipient. The payer typically had a higher tax rate than the recipient, thus the government was losing on tax revenue. By removing that tax deduction for new alimony agreements from 2019 onward, Congress closed that revenue gap. Now here's what that means for you. If your divorce agreement was finalized before January 1, 2019, the payer can still deduct alimony and the recipient reports it as income. For agreements after that date, Congress disregards alimony entirely, no deduction for the payer, and no income reporting for the recipient. And remember, child support is always treated differently before and after that date. It's not taxable, nor is it deductible under any circumstances. Alimony is a significant financial arrangement, and annual reconciliations are essential to keeping this arrangement fair and accurate. Divorce or separation agreements often specify that alimony should be reconciled annually. There's good reason for that. First, alimony is generally based upon earnings that are predefined in the separation agreement. Earnings is not the same for every individual. Some may be employees and others are self-employed. In many cases, total earnings that qualify for alimony cannot be fully determined until after year-end and the returns are filed. One cannot know the actual after-tax income of a person until the actual liability has been calculated. Thus, the true-up can be calculated post-year-end after the returns are filed. As a CPA, I work with clients to conduct these reviews. We gather key documents such as income statements, tax returns, and other financial records. By doing this each year, we can identify any discrepancies between the parties. This could be an overpayment or it could be an underpayment. Moreover, annual reconciliations help prevent disputes. By addressing any discrepancies regularly, both parties can avoid larger, more challenging legal battles down the road. This proactive approach can save time, stress, and potentially costly litigation. Divorce is hard enough, there's no reason to complicate it further. Performing these reconciliations annually provides financial clarity, tax compliance, and peace of mind for both parties. Let's shed some light on some crucial aspects of the tax rules around claiming children as dependents after a divorce. Navigating these rules correctly can make a significant difference in maximizing tax benefits while avoiding potential conflicts and penalties. First, let's talk about the custodial parent. For tax purposes, the custodial parent is defined as the parent with whom the child spends the greater part of the year, regardless of what the divorce decree or separation agreement states. This parent generally has the right to claim the child as a dependent for tax purposes, opening access to several valuable tax benefits. These benefits can include the child tax credit, which can reduce the tax liability directly, and the earned income tax credit, if eligible, which provides an additional benefit to low and moderate income families. Now, there is a way for the non-custodial parent to actually claim the child, but it does require the custodial parent's cooperation. The custodial parent must sign IRS Form 8332, which formally releases their right to claim the child as a dependent for that particular tax year. The non-custodial parent then attaches this form to their tax return. It's worth noting that the release can be done on an annual basis, but it is revocable only with the custodial parent's consent and in some cases, even court involvement. Only one parent can claim the child as a dependent. Only one. Double claiming can trigger audits, penalties, all sorts of related issues, so it's essential that parents coordinate closely and establish a clear agreement. Claiming a child for a dependent also impacts eligibility for several other deductions and credits, including credits for medical expenses, education, and even the child and dependent care credit. Additionally, keep in mind that the child's age and other factors like whether they're a full-time student, meet the IRS's support and residency test, play a role in dependency status. With tax laws changing frequently, particularly those affecting family tax credits, consulting a professional is advisable. A professional can advise personalized guidance, ensure compliance, and help both parents make informed decisions to optimize the tax outcomes for both parties. As a CPA, my role in the property division process during a divorce is to provide clarity on the financial realities of splitting assets, particularly by examining their after-tax values. This approach helps ensure an equitable and transparent distribution, avoiding unintentional consequences down the road. When dividing assets, it's crucial to understand that not all of them are worth their face value once taxes are factored in. Cash, for example, is a straightforward asset because it's already been taxed. But assets like retirement accounts, stock portfolios, and real estate come with tax implications that impact their actual value. If one party receives a retirement account valued at $100,000, for example, they won't actually have $100,000 to spend. They'll likely face income tax and early withdrawal penalties if they reduce it early, reducing the amount that they can actually access. For investment properties or stock portfolios, we must consider capital gains taxes, which will be owed on any gains since the asset was acquired. This means that if one person takes the property and sells it later, they may have a significant tax liability. By identifying each asset's cost basis and current market value, we can estimate the capital gains tax to be paid upon the sale, giving both parties a clearer picture of the property's true after-tax value. Furthermore, when splitting these assets, fairness must be applied. You got to ensure both parties receive equitable cost basis. It would be totally unfair, for example, to give one spouse lower cost basis than another, and they would have an uneven tax split on the basis. Another factor to consider is timing. Some assets like stocks, real estate, I also advise considering potential changes in tax law or economic conditions that could affect the value of these assets down the line. Structuring these split with these factors in mind helps ensure that each party gets a fair, even distribution, even as circumstances happen to change. In short, what you want to do is consider all tax implications so each person can see what they're truly walking away with. By taking this approach, you can avoid a misunderstanding and create a property split that reflects a genuine value of the assets, ensuring a fair outcome for both parties.